What if I told you the biggest determinant of your home's future value isn't its granite countertops, the sparkling new appliances, or even the latest designer paint colors? It's something far more subtle. And if you miss it, you could be leaving hundreds of thousands of dollars in potential equity on the table. Welcome to Keystone Property Advisors, where we equip you with the insights to make smarter property decisions. Today, we're revealing the hidden signals that allow you to spot a home that will appreciate quickly, turning your purchase into a powerful wealth-building engine. The truth is, most people buy homes based on emotion and immediate gratification. First-time home buyers often fall for curb appeal and move-in readiness, overlooking critical factors that drive long-term value. Property investors might get caught up in superficial renovations, missing the underlying market forces at play. Even experienced homeowners looking to upgrade often focus on what they're wanting in a new home rather than what the market will value most in the coming years. This isn't just about finding a good deal. It's about understanding the financial and strategic mistake of treating a property purely as a consumption good rather than an appreciating asset. It's why some homes double in value, while others barely keep pace with inflation, even in the same market. Experienced property investors and savvy home buyers understand that rapid appreciation isn't random. It's a predictable outcome of specific underlying drivers. They don't just look at what a property is today, but what it can become, and more importantly, what the surrounding market is evolving in time. This requires a mindset shift, moving from a focus on personal preference to a keen analysis of fundamental economic, demographic, and local development forces. It's about seeing property not just as shelter, but as a strategic investment where future value is built on a foundation of observable trends and potential. The first pillar in spotting rapid appreciation is analyzing the neighborhood's trajectory. Look beyond current aesthetics. Are there significant infrastructure projects underway or planned? Think new transit lines, major road upgrades, or public amenity developments like parks and recreation centers. Research local government zoning changes or revitalization initiatives. What are the demographic shifts? Are young professionals, families, or specific industries moving into the area? Strong indicators include rising household incomes, new cafes and independent businesses opening, and even the presence of new construction indicating developer confidence. These are all signals of an area on an upward climb, attracting more demand and driving property values. Next, evaluate the property itself, focusing on its intrinsic value and potential for improvement. A home with good bones, a solid structure, a desirable floor plan, or a larger than average lot often has more appreciation potential, even if it needs cosmetic updates. Look for properties that are currently undervalued due to deferred maintenance or outdated aesthetics, but are structurally sound. Can you add value through smart renovations that enhance functionality or curb appeal without over-improving for the neighborhood? Consider zoning laws. Can you add an accessory dwelling unit or expand in a way that significantly increases square footage? This is about finding the diamond in the rough, where your investment in time or capital can yield disproportionate returns as the property reaches its full potential. The third pillar focuses on the broader economic landscape. Property values are deeply tied to the health of the regional economy. Is there robust job growth, particularly in high-paying sectors like technology, healthcare, or education? Companies expanding or relocating to the area create demand for housing. Look at population growth trends. Is the region attracting new residents? Scrutinize supply and demand dynamics. Areas with limited housing inventory and high demand are prime for appreciation. Understanding these macroeconomic forces allows you to invest in regions that are fundamentally poised for growth, rather than relying on short-term market fluctuation. Let's illustrate this. Imagine two homes. Home A is a beautiful, turnkey property in an already established, highly sought-after neighborhood, priced at the top of the market. Home B is slightly older, needs some cosmetic updates, but is located in a transitioning neighborhood. This neighborhood, however, has a new light rail station opening next year. A major tech company just announced a new campus nearby, and local zoning allows for a potential extension. A first-time home buyer focused solely on aesthetics might choose Home A for its immediate appeal. But the strategic investor, applying our 3 pillars, would recognize Home B as the clear winner for rapid appreciation. The combination of future infrastructure, job growth, and intrinsic value-add potential means Home B is poised for significantly faster equity growth. Spotting homes with rapid appreciation potential isn't just a clever trick. It's a fundamental strategy for building substantial long-term wealth through real estate. Faster appreciation means accelerated equity growth, allowing you to leverage your asset for future investments, better financial stability, or the ability to upgrade your lifestyle sooner. It transforms your property from a simple roof over your head into a powerful engine for financial freedom. By applying these 3 pillars, understanding neighborhood trajectory, recognizing intrinsic property potential, and analyzing regional economic health, you move beyond guesswork and make truly informed, strategic property decisions. Start seeing property not just as a place to live, but as an appreciating asset that can profoundly shape your financial future.